Today we're answering the question at hand. What is capitalization rate in commercial real estate? And by the end of the video, not only will you master the one critical number that reveals whether a commercial property is a gold mine or a money pit in seconds, but you'll also learn how to use cap rates like a professional investor. This is to spot hidden opportunities that others miss, avoid overpriced properties and investment mistakes that could cost you millions. $1 million deals happen every day in commercial real estate. But what most people don't know is that the biggest investors rarely look at the property's price tag first. Instead, they focus on one simple number that tells them everything that they need to know. This number can reveal whether a property is a gold mine or a money pit, and it's called, ready, drumroll, the capitalization rate or cap rate. Now, understanding this cap rate could be the difference between making and losing millions in a commercial real estate transaction. Think of cap rate as your property's annual performance score. Now, just like a car's miles per gallon tells you its efficiency regardless of the price tag, cap rate tells you the property's income potential regardless of its price tag. This number has saved countless investors from overpaying for underperforming properties and helped others spot hidden gems like less informed buyers would have missed. In the next few minutes, we're going to break this down exactly how cap rates work, when to use them, and more importantly, how to use them to make better investment decisions. We're going to look at some real numbers, work through actual calculations, and show you how to apply this knowledge in the real world. But first, let's clear up the biggest misconception about cap rates. See, these cap rates are not just a formula to memorize, they're a tool that reveals the story behind every commercial property. At its core, cap rate represents the percentage of a property's total value that you earn back each year in net operating income. Now, the formula is simple. A property's net operating income divided by its market value expressed as a percentage. So for example, let's take a commercial property that generates $500,000 a year in annual net operating income and is listed for $5 million. Well, we divide 500,000 by 5 million and you get 0.10 or a 10% cap rate. This means the property generates a 10% return on your investment annually before accounting for your mortgage payments. However, the net operating income isn't the same as gross rental income. To find your true net operating income, you need to subtract all operating expenses from your gross rental income. Now, these expenses include property taxes, insurance, utilities, property management fees, and any other regular costs needed to keep the property running smoothly. So let's use this for an example. Let's say your property generates $800,000 in gross rental income, but has $300,000 in annual operating expenses. Your net operating income would be $500,000. Now, what makes cap rate so powerful is that it lets you compare different types of commercial properties on an even playing field. It cuts through location differences, property types, and price points to show you the pure income generating potential of each property. For example, let's say a property A is a retail space generating $200,000 in net operating income, and it's priced at $2.5 million. Well, that cap rate would be, do the math, 8%. Now, property B, well, that could be an office building generating $400,000 in net operating income and is priced at $4 million. The cap rate in that example, you got it, would be 10%. At first glance, property B might seem more expensive, but its higher cap rate tells us it actually generates better returns relative to its price. This is exactly the kind of insights that helps experienced investors spot opportunities that others miss. However, a higher cap rate isn't always better. Cap rates can also reflect risk. Generally, properties with a higher cap rate often come with higher risk factors. Now, that might be in a less desirable location, for example, or have deferred maintenance issues. Maybe it operates in a more volatile market. Think of it like this. Treasury bonds typically offer lower returns, but are considered very, very safe investments. Similarly, a prime office building in a major city might sell at a 5% cap rate because it's considered a stable, low-risk investment. Meanwhile, a struggling strip mall in a declining neighborhood might sell at, say, 12% cap rate, reflecting both its higher potential returns and its higher risk. You see, this relationship between risk and return brings us to our next critical point. market cap rates. Every market has its own typical range of cap rates for different property types. Understanding these ranges is critical because it tells you what's your normal market cap rate, for example. And understanding these ranges is critical because they tell you what's normal in your target market. For example, let's take a mid-sized city where multifamily properties typically trade at a 6 to 7% cap rate. Retail spaces at 7 to 8, and industrial properties say at 8 to 9%. Now these ranges become your baseline for spotting opportunities. For instance, let's say multifamily property listed at $3 million with a net operating income of $240,000. Well, that gives us an 8% cap rate in a market where similar properties trade at 6 to 7%. The higher the market cap rate should prompt some important questions. 1. Why is the seller offering such a high return? Is there deferred maintenance? Are there problems with the tenant mix? Or did you just find an undervalued property? This brings us to one of the cap rate's most valuable uses: quickly identifies properties that warrant deeper investigation. Now, when you spot a cap rate that's significantly different from market norms, it's like a flashing signal telling you to look closer. A property's cap rate doesn't just tell you about its current performance, it can also reveal opportunities for value creation that others might have missed. For instance, let's say a property with a current cap rate of 7% is in a market where similar properties trade at 5%. This gap could signal one of two things. Either the property has serious issues driving down its value, or it has untapped potential that could be unlocked through better management. This is where your expertise as an investor comes into play. For example, a 100,000 square foot office building generates $600,000 in net operating income and is listed at $10 million, giving it a 6% cap rate. However, you notice that the property's occupancy is only 75%. While similar buildings in the area are at 90% occupied. Now, through better marketing and property management, bringing occupancy up to market standards, well, that could increase net operating income, say, to $720,000. Now, at the market cap rate of 6%, this improved net operating income would justify a property value of $12 million. This $2 million increase in value comes purely from better operations without any major renovations being required. See, this is how understanding cap rates helps you spot value-add opportunities. But cap rates do more than just help you analyze individual properties. They also tell you important things about market trends. You see, when market cap rates start trending down, it usually means property values are going up. And when they trend up, property values are likely declining. This makes cap rates a valuable tool for timing your market entry and exit. However, it's crucial to understand that cap rates have limitations. They work best for stabilized properties with consistent income streams. For properties under development, those requiring significant renovation, or those with highly variable income, cap rates might not tell the whole story. In these cases, you'll need additional metrics like the internal rate of return or cash-on-cash return to make fully informed decisions. This brings us to how cap rates interact with interest rates and market conditions. When interest rates rise, cap rates will typically follow, though not always at the same pace or magnitude. This relationship exists because higher interest rates increase the cost of capital, making investors demand higher returns from their investments. Here's an example. If prevailing interest rates rise from 4% to 6%, investors might shift their cap rate expectations from 6 to 7 or even 8%. This shift can significantly impact property values. Remember our earlier example of a property generating $300,000 in net operating income? Remember that one? A 6% cap rate, it's worth $5 million. But if market cap rates rise to 7.5 due to higher interest rates, the same property's value now drops to $4 million. That's a 20% decrease without any change in the property's income. This relationship becomes particularly important in our current market environment. As interest rates change, understanding how they affect cap rates and by extension property values can help you make better investment decisions and potentially spot opportunities that others miss. Another sophisticated way investors use cap rates is through portfolio balancing. You see, different property types and the locations typically have different cap rate ranges. A well-structured portfolio might include some lower cap rate properties for the stability they offer, things like grocery-anchored retail centers in a growing suburb, for example, balanced with higher cap rate properties for better cash flow, like a well-maintained industrial property in a secondary market. You see, by understanding how these different cap rates reflect different risk and return profiles, you can build a portfolio that matches your investment goals while managing risk through that diversification we just discussed. So, where does this leave you as an investor? Let's bring all of this together with some actionable takeaways that you can start using today. First, always calculate the cap rate before making any commercial real estate investment decisions. Remember, our simple formula, net operating income divided by property value. This gives you your baseline for comparison and helps you avoid overpaying for properties. Second, research typical cap rates in your target market. Contact local brokers, review recent sales data, and build a database of cap rates for different property types. This market knowledge will help you spot both overpriced properties and hidden opportunities. Third, use cap rates as part of your larger analysis toolkit. While they're incredibly useful, they work best alongside other metrics like debt service coverage ratios, cash-on-cash returns, and internal rates of return. Think of cap rate as your first filter. Call it a sniff test. They help you quickly identify which properties deserve a deeper look. Fourth, monitor cap rate trends in your market. As they compress or expand, understanding these trends helps you time your purchases and sales more effectively, potentially leading you to better returns on your investments. And then finally, remember that cap rates are just the beginning of your property analysis journey. They're not the end. Commercial real estate success isn't about making quick decisions, it's about making informed ones. You got it? Not quick, but informed. Cap rates give you the framework to do exactly that, helping you spot opportunities that others have missed while avoiding costly mistakes that others make. The real power of understanding cap rates isn't just in the math, it's in the confidence that it gives you to make better investment decisions. And whether you're analyzing your first property or your 100th, this fundamental metric will continue to guide your path to successful commercial real estate investing. They're a powerful tool that helps you speak the language of commercial real estate and make more informed decisions. It's all about the information. Going forward, your cap rate analysis, your first step, it's all in evaluating any commercial property. Use it as your initial filter to quickly identify which properties deserve a deeper look. But always remember to dig deeper. Understanding why a cap rate is what it is often reveals the best opportunity. Look, if you got some value out of this video, be sure to like and subscribe, click all the stuff that you know you have to do. Click that bell so that you get notified when I'm posting these videos. And I'll see you in the next one, and you can access it right here. Okay? Take care. Bye.